Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
The yen carry trade may be entering a dangerous phase. This article was written by Mott Capital Management. Summary: the Bank of Japan held rates steady, providing no clear guidance on future hikes, initially weakening the yen. Despite rising yen forward rates, JPY is not strengthening as historical patterns would suggest, signaling unusual market dynamics. Hedging costs for yen exposure are falling, indicating low demand to hedge and expectations for continued yen weakness. Bond market volatility underscores heightened uncertainty around Japan's fiscal and monetary policy direction. Michael Kramer, founder of Reading the Markets, blends macro themes, technicals, and options flows to spot opportunities and turning points across asset classes. Learn more. The Bank of Japan decided not to raise rates at its January meeting. The decision to pass on a rate hike and the lack of clarity about when another will come initially weakened the Japanese yen versus the dollar to around 159.25. It wasn't until later on Friday, January 23rd, that fears of intervention became a threat. For now, it seems the course of action is to drag out the rate hiking process for as long as possible, even as the Prime Minister is proposing more stimulative fiscal policies. Given this approach, the only recourse of action at this point appears to be intervention, because monetary policy in Japan is loose, and loose fiscal policy, the yen is diverging from fundamentals. On the surface, the yen forward rate is rising, suggesting a stronger yen ahead. But at the same time, JPY is not responding in the manner expected. Historically, when the forward rate rises, the USD JPY falls. That doesn't seem to be happening at the moment. Also, the rate to hedge yen for dollars has been steadily declining. This suggests that demand to hedge yen is currently absent. It could be an indication that either traders expect the yen to continue to weaken against the dollar, or that current intervention threats will fall by the wayside. Certainly, volatility in the bond market could signal nervousness about both fiscal and monetary policy. Additionally, a 2-year JGB trades at just 1.27%. And with a break-even inflation rate of about 1.8%, the real yield in Japan is about negative 60 bips, suggesting policy is still loose. Only one option left. It seems that if the government is going to run loose fiscal policy and the BOJ is going to run loose monetary policy, then the only course for Japan to control the yen is through intervention or threats of intervention. The spread between the expected 5-year forward outright rate for the yen and the spot rate has been steadily shrinking. And, at least technically, it could shrink further. The chart should look familiar, as that spread is the same as the spread between the US 5-year Treasury rate, US 5Y, and the 5-year JGB rate. The interest rate differential between the two has closed dramatically, and again, at least based on the trend, it would appear it may have further to close, which essentially should push the spread between the yen spot rate and the yen 5-year forward to contract as well. But there is now a significant divergence between the interest rate differential and the USD JPY FX rate. The last time the USD JPY weakened, as the spreads were in the summer of 2024, was when Japan intervened in the FX market. Given today's interest rate spreads, one would think the JPY would be stronger than it currently is. The risk, of course, is how far the yen must strengthen, and whether this will negatively impact risk assets. Generally, thought would be yes, it likely would, as the cost of hedging yen versus the dollar, as measured by the 5-year cross-currency basis swap, has been virtually identical to the S&P 500 for a few years now. This would result in the unwinding of the yen carry trade that many investors have been eagerly awaiting. Again, this is not hard to track, so once the signs emerge, it should be fairly easy to see. This article was written by Mott Capital Management. The bullish and
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.